Let me tell you about the worst investment advice I ever got, and why ignoring it made me rich. A guy at a party once told me something. If your portfolio isn't exciting, you're doing it wrong. I believed him for almost 2 years, and I lost money chasing that excitement. Then I discovered something different, something so boring, so unglamorous, that it actually worked. It's called index fund investing, and today I want to walk you through it from a completely different angle than most finance videos, not as a list of ticker symbols to memorize, but as a mindset shift, one that changes how you see money forever. Because here's the truth nobody tells beginners. The stock market doesn't reward excitement, it rewards patience. And patience is something almost anyone can practice, regardless of their salary. So let's start with a question. One, most people never actually stop to ask, what are you really buying when you buy a stock? You're buying a tiny sliver of ownership in a company, a claim on its future profits. Now imagine trying to guess something. Out of thousands of companies, which ones will thrive over the next 20 years? Even professional fund managers get it wrong. People who do this full time, with teams of analysts. Study after study has shown something surprising. The majority of actively managed funds fail to beat the broader market over long stretches of time. So if the experts can't reliably win that game, why do so many beginners think they can? This is where index funds flip the entire script. Instead of trying to find the needle in the haystack, an index fund just buys the whole haystack. Think of it like this. Instead of betting on which single restaurant in a city will become the next big hit, you invest in every restaurant in the city at once. Some will fail, some will struggle, but the strongest ones will carry the average upward over time. That's essentially what an index fund does with companies instead of restaurants. It holds a huge basket of businesses, and your return simply mirrors how that whole basket performs. No guessing, no gambling, no gut feelings. Now let's talk about where this idea actually came from, because the origin story is more interesting than people realize. Long before the S&P 500 was a household phrase, investing was seen as something reserved for the wealthy and the well-connected. Ordinary workers were expected to hand their money to a fund manager and simply trust that person's judgment. Those managers often charged steep fees, sometimes over 1% a year, regardless of whether they actually beat the market. In the mid-1970s, something changed. A Princeton graduate turned financial executive challenged this entire system. He argued that most people would be better off owning the market itself, rather than paying someone to try and outsmart it. Critics mocked the idea at the time, calling it a guarantee of mediocrity. But decades of data eventually proved him right. That mediocre strategy quietly outperformed the majority of expensive, actively managed funds. That's the paradox at the heart of index investing. By aiming for average, you often end up beating most people who aimed for greatness. It's the tortoise and the hare, except the tortoise is holding a diversified portfolio, and the hare is checking stock prices every 4 minutes. Now let's get into how this actually works mechanically, because understanding the machine helps you trust it. An index is simply a benchmark, a defined list of companies that represents a segment of the market. Some indexes track the 500 largest publicly traded companies in the United States. Others try to capture nearly the entire investable stock market, from massive corporations down to small emerging businesses. An index fund is built to mirror one of these benchmarks. As closely as possible, if a company makes up 2% of the index, the fund holds roughly 2% of its money in that company. As the index changes, the fund automatically adjusts, with no human being sitting there making emotional decisions about what to buy or sell. This is a huge psychological advantage, one that people rarely talk about, because humans are terrible at making rational decisions. When money and fear are involved, we panic sell during crashes and get greedy during bubbles, doing exactly the opposite of what builds wealth. An index fund removes that emotional temptation from the equation almost entirely. You're not reacting to headlines. You're not refreshing an app 5 times a day. You're just steadily participating in the market's long-term growth. Let's pause here and address something important. Index funds are not exciting, and that's precisely the point. Excitement in investing usually means volatility, and volatility usually means risk. If your portfolio gives you an adrenaline rush, that might be a warning sign, not a bragging right. Wealth building in reality looks different than people expect. It looks more like watching grass grow than winning a poker hand. It's slow, it's repetitive, and most of the action happens quietly in the background, over years, not days. Now let's talk about diversification, because this is where a lot of new investors get confused. Imagine you planted an entire garden, but only ever grew one type of vegetable. If a disease or a bad season hits that specific crop, your entire harvest is wiped out. Now imagine instead you planted dozens of different vegetables across your garden. Even if a few crops fail, others thrive. and your overall harvest stays healthy. That's diversification in a nutshell. And it's exactly what broad index funds give your money. Instead of betting your future on one company's fate, you're spreading that bet across hundreds or even thousands of businesses. This doesn't eliminate risk entirely, nothing does, but it dramatically reduces the danger of a single catastrophic loss wiping you out. Now let's talk about fees, because this quietly destroys more wealth than people realize. Picture two pizza shops on the same street, selling identical pizzas made from identical ingredients. One shop charges you $2 extra per slice, just because they can. Over one visit, that seems small, almost forgettable. But if you eat there every week for 30 years, that small overcharge adds up to thousands of dollars lost for absolutely no additional value. That's essentially what a high expense ratio does. Inside an investment fund, two funds can track the exact same market, holding nearly identical companies. Yet one quietly charges you far more each year, simply for existing. Over decades, that difference can cost you a lot. Tens of thousands, sometimes hundreds of thousands of dollars in lost growth. This is why comparing expense ratios matters, just as much as comparing the funds themselves. A fraction of a percentage point sounds trivial in the moment, but compounded across 30 or 40 years, it becomes enormous. Now let's talk about what you're actually choosing between. When you look at index funds today, broadly speaking, you'll encounter two main flavors. The first tracks a smaller, more concentrated slice of the market, typically the largest and most established companies in the country. The second casts a much wider net, holding not just giant corporations, but also mid-sized and smaller companies across the entire market. Neither approach is objectively better in every situation. They simply offer different balances of concentration versus breadth. A narrower fund tends to be dominated by a handful of massive companies that carry outsized influence over its performance. A broader fund spreads that influence out further, capturing more of the economy's total growth story, including tomorrow's rising businesses. Many long-term investors choose to hold both, blending concentrated strength with wider diversification. There's no single correct formula here. What matters is understanding the trade-off you're making. Now, every major brokerage today offers its own version of these funds. And yes, they do differ in small but meaningful ways. Some require a minimum amount just to open a position, while others let you start with a single dollar. Some charge a tiny sliver of a percent in fees each year, while a few have pushed that fee all the way down to zero. The number of companies each fund actually holds can vary too, depending on how strictly it follows its target index. None of these differences are dramatic on their own, but together they shape your long-term outcome. So before choosing a fund, take some time. It's worth spending 20 minutes comparing options. Across a few major providers, look at the expense ratio first, since that's the cost you'll pay every single year. For as long as you hold the investment, look at the minimum investment required, since that determines how quickly you can actually get started. Look at the long-term performance history, understanding that past returns never guarantee future results, but they do show consistency. And finally, consider your own comfort with the platform itself, because you're far more likely to stay consistent. With a brokerage, you trust and understand. That consistency, by the way, is the real secret ingredient here. More than any specific fund choice, let's talk honestly about mindset for a moment. Because the psychology matters more than the spreadsheet. Most people don't fail at investing because they picked the wrong fund. They fail because they stopped, or panicked, or pulled out during a downturn. The stock market has weathered wars, recessions, pandemics, and political chaos, and it has still trended upward across every multi-decade stretch in modern history. That doesn't mean every year is a good year. Some years are brutal, even painful, even frightening. But zoom out far enough, and the short-term noise fades into a long-term climb. This is why automating your contributions matters so much. When you invest a set amount every single month, regardless of whether the market is up or down, you're practicing something called dollar cost averaging. Some months you'll buy at a high price, other months you'll buy at a discount, and over time those swings tend to average out in your favor. This strategy doesn't require you to predict anything. It just requires you to show up consistently, and that consistency is available to almost anyone, whether you're earning a modest salary or a large one. You don't need to be a Wall Street insider. You don't need insider knowledge, and you certainly don't need to check your portfolio every day. In fact, checking too often can work against you, tempting you to react emotionally to short-term dips that don't matter in the long run. Some of the most successful long-term investors barely look at their accounts, and that's not laziness, that's discipline. Now, I want to address a common objection, because I know some of you are thinking it right now. If everyone just buys the index, isn't that boring? Isn't there a smarter way to get rich faster? Sure, some people do get rich faster through concentrated bets, timing the market, or picking the right stock at the right moment. But for every story like that, there are countless untold stories of people who tried the same thing and lost everything. Survivorship bias makes the winners loud and visible, while the losers quietly disappear from the conversation. Index investing isn't designed to make you rich overnight. It's designed to make wealth building statistically probable rather than statistically lucky. That distinction matters enormously if you actually want to reach financial independence with confidence, not just hope. Let's also talk briefly about taxes and account types, because where you hold these investments matters, almost as much as what you hold. A workplace retirement account often gives you access to tax advantages, sometimes even matching contributions from your employer, essentially free money added to your investments. Outside of that, individual brokerage accounts offer more, and other tax-advantaged accounts offer additional flexibility. For different goals and timelines, understanding these structures isn't as intimidating as it sounds. It just takes a little research up front to make your money work as efficiently as possible. Now let's bring this back to the bigger picture, because numbers alone don't tell the full story. Wealth isn't really about the size of the number in your account. It's about the freedom that number eventually buys you, the freedom to leave a job that drains you, to spend more time with people you love, to make choices based on meaning instead of survival. Index fund investing isn't flashy, and it will never make for a thrilling headline. But quietly, patiently, month after month, it has helped ordinary people build extraordinary financial futures, not through luck, not through timing, but through steady, unglamorous consistency. So if you're standing at the beginning of your own investing journey, here's my honest advice. Stop searching for the perfect entry point, because it doesn't exist, and waiting for it will only cost you time you can't get back. Start small if you have to. Even a modest monthly contribution builds a habit, one that compounds far beyond the dollars alone. Learn the difference between the fund types available to you, compare their costs, and choose the ones that align with your goals and your comfort level. And then, perhaps most importantly, let time do what time does best. Because in investing, boring isn't a flaw. Boring is the strategy. And sometimes the most powerful financial decision you'll ever make is simply choosing to stay the course.